whether they're willing to try and learn something new. And Patrick, I haven't met anyone so willing to jump into so many things. You are, can I tell the audience what you're doing? No, you tell them.
Some of them will be in the presentation.
All right, yeah. Oh, you're going to put it in the presentation. So, you rappelling, right? Is it rappelling? Jiu-jitsu?
Jiu-jitsu.
Yep, so he is entering competitive jiu-jitsu match. You started jiu-jitsu when?
2.5 years ago.
Yeah, all right, so he dropped, you cut how many pounds? Can I share that?
For the most recent match, I dropped 12 pounds.
12 pounds, so he didn't have to fight 180-pounders. So with that, really intersecting this concept that the market sees patterns, Patrick's going to talk a lot about that. Go ahead, it's all yours.
All right, excellent. Yeah, on that intro, I learned one thing in martial arts. Is another thing I'll include in here in my presentation. But one thing I definitely learned quickly was that the bigger guy in a fight always wins, actually, most of the time. So it's much better to fight people your size if you have the choice. This is great. So Dave asked me to maybe do 20 minutes or so on technicals. He was kind of broad on how he described what he might want to talk about. I was reminded of a anecdote of Woodrow Wilson, who said, I can give you a 15-minute presentation, but that will take me months to prepare. If you want a 2-hour presentation, I can start that right now. Because it's always about trying to synthesize exactly what you want to talk about. So I thought I would do this. Given the short amount of time, I really just want to talk about how I came to technicals, why I find them useful, and then hopefully maybe just give you a few kind of rough ideas of how you might use some very basic concepts. Obviously, if I couldn't teach you all of technical analysis or talk about it all in a 20-minute talk, there's a whole designation you can get, CMT. It's 3 levels of exams doing on technicals. So this is what most people generally think about technical analysis, at least when you bring it up, that it's kind of voodoo, that it's witchcraft, that it involves some mystifying chart patterns. That's not really what technical analysis is about. Technical analysis is really just completing a research picture, looking at supply and demand of the underlying instrument, right? You want to look at volume and price as reflecting what others believe about an investment, not just what you believe about it. When people cite what's wrong with technicals, they'll say, if you tried to time the market, you were out of the market for these periods. And certainly, the chart on the left would say, here's what happens if you market time and you missed the 50 best days in the market, then see how much you underperformed the market if you didn't have that. Flip side of that is if you avoided the worst days, you also outperformed the market quite a bit. So it actually comes down to net. It's probably worth at least some discipline in how you think about timing your investments and where you are and how you're positioned in the market. And I'll give you some data around this. I just want to talk briefly about one of the things that sort of led me to thinking about technicals more broadly. And this was a book by Mandelbrot about fractal geometry and the markets. And it's a really refutation of the efficient market hypothesis and many of sort of this normally distributed thinking about risk models. Right? Risk is not normally distributed. Tails are extremely fat. If we look at over the last just 2 decades, we've had multiple sort of 6 sigma risk events that have happened that should have only happened 1 in a million years or more if it was actually normally distributed. But risk is not normally distributed. And so because those tails are fat, but not only that, markets are fractal. So I think everyone probably understands what fractals are, but the big things look like the little things, right? So, and one of the key things of technicals is that you can see the patterns across different durations. So we can see them over long-term durations, medium-term duration, short-term duration, even down to daily intraday patterns. These tend to look similar. There's a chart here, sort of in the background that I've got just a picture there. Is not an actual stock chart. That's just one derived through just using fractal math. You sort of created a fake stock chart price. And that's sort of shows how that math is sort of underlying the market structure generally. So therefore, there are recurring patterns in the market. They are because they're a function of all the different agents working together that, the emergent properties of those things are the patterns that show up in the market consistently. Not always the same, but they do rhyme. So I went to Bowdoin College undergrad, and unfortunately, I am not the most famous investor to have graduated from Bowdoin College. That distinction would probably go to Stan Druckenmiller. I just pulled a couple of quotes of his because, one, I think his track record speaks for itself. He averaged something like 30% per annum over 3 decades across the different platforms he's run. But he points out, I've kind of pulled a couple from different interviews, where he talked about, that timing the market, technical analysis, and liquidity considerations as well. But that would help him sort of not only creating his thesis around an idea, but when it might be the timing to exploit that. He's famous for taking big bets, famous for changing his mind and staying very fluid, right? And letting the market tell him when he might be off and then reacting to that quickly, as opposed to maybe doubling down. I'll ask a quick question. I was going to include this data, but since I didn't, I'll just ask it sort of as just to throw this out there. There was a study of day traders that I looked at, where over 20 years of data, and anyone want to take a guess as to what percentage of the trades made were actually directionally correct?
53.
Is that?
53.
It's a good number. I like it. 87%, actually. But how many day traders across that were profitable? What percentage?
Okay.
Better than that, but well less than 50, right? So what was the difference? The difference is they tended to cut their winners and hold on to their losers, and they tended to weight things incorrectly and become stubborn sometimes with bets, and therefore they're over, even though on average, their batting average actually looked quite good, the overall outcome was not great. This just speaks to having some discipline in your decision making, right? And having some rules and being acutely aware of what other people think is an important part of this. And this sort of brings me to another book that was very formative in thinking about investments for me. This is a room full of predominantly, looks like middle-aged males, but there's quite a few poker players in here if I asked for a set of hands. But when people ask me about investment books that were important to me, one of them is not really an investment book. It's The Theory of Poker by David Sklansky. There are a couple of just key concepts that I think matter a lot in thinking about looking at investments and how the prices are changing and how they're trading. One is just concepts of pot odds, right? Based on the information I know, is it really worth making this bet, right? And that leads to the value of a good fold, that if I just don't really think I have it, I should just walk away. There's no reason you have to be in it. But the most important one to me is he talks about bluffing and the value of deception, or you can't really do that with the market, right? I can't bluff the market. That's really hard to do. But you can read the other players. And if I thought I was dating myself with a reference to this movie, but then Dave included Star Trek and Gomer Pyle. So now I feel like a youngster, bringing up a movie called Rounders, which you could see Ed Norton and Matt Damon in their very young, sprightly days were in this movie. I don't know if anyone remembers this movie, but it's kind of like the Karate Kid of poker or something, right? It's about the underground poker scene. But there's a great quote in there and there's a great scene in the movie where he just blind reads a table, right? He's just sitting there, he's doesn't even look at his cards. He's just he's pointing at it, he's you were looking for that king, but you didn't get it. You were holding a pair of threes. I don't know why you were still in the pot. He just goes around and the point is that you want to look at your own cards. Obviously that's important, but you want to see how other people react to that. Examples of this, of how I think about it in the market. Does the stock continue to go up on lower and lower volume? All right, then that's telling you something about maybe it's running out of momentum. Or what happens if you news that's positive news, but the stock kind of is up and then goes down? All right, then maybe it's already priced in. So what is sort of already in the market. Company reports an enormous earnings miss. Stock is up. Okay, well then what does that tell you? That's information. That's important information. So to that point, what does the reaction tell you about the fundamental picture? And I'll just to elaborate why I think poker is such a great analogy to investment, as much as some people find that anathema to say it, is because of more of the informational structure, right? I'm handed cards, and I have my set of information. there are other people at this table who have other sets of information. Those are of varying quality, right? Some people have very good information, some people have very bad information. We are all reacting to new information that is coming at you every single time, right? And that's shifting the odds and changing the probabilities of what. So seeing how others react to it tells you a lot about what information you have that might be right, how it relates to the information that's on the table, and how it relates to others. So I say this all because when I think of reading the tape, or when I think about technicals, that's how I think about it. Like you're looking for information about what others might think of it, or also as a risk management tool to prove that what I know might not be right? Because you don't want to become so wedded to your information set that you are willing to stick with that loser, right? Even though you're now ignore the fact that the market is now telling you what you know about this may not be correct. I worked with an investor years ago who said, the value of information decays over time. So whatever information you have, it's already old by the next day, and it's aging quickly because things are changing. So I said I was going to bring up martial arts, so I included this because when I was trying to think about things I wanted to synthesize down about technicals or reading the tape, there's a lot you could talk about, but I wanted to sort of just sum it up in sort of structure and transition. And the reason I say that is because again, this is not common sort of way of thinking about martial arts, but it's something that I've studied it on and off over the years, and I've gotten much more serious about it over the last decade and a half. And as Dave mentioned, talked about, I've been doing jiu-jitsu the last 2.5 years. And what I find is studying different martial arts, I found there's some commonality to structure and transition. You don't want to attack structure directly, right? You're waiting for structure to be in transition, and that's your opportunity, right? And I liken this a little bit to looking at sort of trend following and then technical analysis. A lot of the trend following tends to be following, a good positive trend is in place, a good negative trend is in place. You may have reason to believe that trend is going to change, but do you want to wait for it to show you exhibit signs that it's changing, or do you want to just continue to try to fight that? And I find fighting structure directly on, very difficult to do. Waiting for a break in that structure and seeing a change or transitioning to new structure, that's your opportunity. And that's how a lot of times how I think about jiu-jitsu. It's really tough to fight positive and negative structure. That is just fact. And I would argue that most of the forces that cause this are only getting stronger, not weaker at the moment. Now, that may change in the future, but at least right now, it's only getting stronger. This is, on the one side, the chart is from Ken French. It's just looking at, this is a really straightforward model. Just buy the stocks, rebalance monthly, that have done the best over the last 12 months, and sell. And then bottom is the performance of the stocks that, if we rebalance, the ones that did the worst over the past 12 months. Rebalance that monthly, and that's the deciles as they fall out. So you can see it's a pretty good naive predictor of performance, is just to buy things that have worked, continue to work. It's a very naive model, right? Sunny today, should be sunny tomorrow, right? I could bet that it's going to rain, and it might, but it might not, right? And as it wasn't raining today, so you only want to wait, right, to see if it changes. Now this is on the left. I was just citing another one that was updated in 2018. Doing another 90-year study of this and showing that even a long-short model that was balanced out for all other factor attributions, just looking at taking long positions in positive past return stocks and short positions in negative, it's a 9.5% annualized return. That seems crazy. It almost shouldn't exist. Why should that arbitrage exist? I would say that's probably only gotten stronger, not weaker. Why do I say that? We've referenced it already. Passive investing. Passive investing makes no attempt to decide whether or not value is correct, whether it's actually just kind of a cap weighted. I would say it's actually actively weighted. It's just not actively weighted by any real fundamental analysis. It's cap weighted and somewhat momentum based. And so, you can add on to that passive investing algorithms that then run this same math and now try to follow it, right? If they follow that, it's only going to amplify this. Now add on to that social media and other things that cause mob-like behavior, and we have a recipe for narratives to just sort of continue to exacerbate returns until such time as they change. So my argument is don't try to force that change. If I have an alternate narrative, I don't necessarily want to fight that narrative until I see reason to think it's shifting. Because when we think about, so I obviously I'm a CFA and a CMT. Most of my career has actually been as a fundamental analyst and portfolio manager. So really, technicals were only ever something I used as risk management or as a guide to how to allocate my time, right? I referenced Stan Druckenmiller earlier. A great quote that I came across of his was something to the effect of, I can look at 1,000 charts in an hour. I can't read 1,000 earnings reports, right? So if you're already trying to think through which ideas do I want to spend time on, well then ones that have either good structure or look like they're in transition, those would be the things to kind of maybe spend your time trying to figure out if there's an angle that you could actually work on. Because I look at it as, we're trying to attempt to find intrinsic value. That's great. There are 100,000 plus CFAs out there trying to determine the intrinsic value of investments. That doesn't even count the people who have MBAs, the hundreds of thousands of people with MBAs, and both of those. Technical analysis, there are 4,500, I think roughly, Carl, 4,500 CMTs. Actually, the intersection of people who are both CFA and CMTs, it's a very small select group of maybe about 22,000 or so. But I would say that even intrinsic value, right? We discussed a lot about fundamental investing. Even intrinsic value is a narrative, right? Dave talked a lot at the start about narratives, and I think it's important because most of the time, even you're telling yourself a story, even if you have math to add to that story, right? Very early on, when I was probably getting my CFA, I was working on building a discounted cash flow analysis and trying to look at this. And I realized when I started looking at it, I'm like, wait, well, like 60 to 80% of the value in this thing is in year like 5 through whenever. So if I just toggle a couple of assumptions, like it changes a lot. So we're all anchored on forecasting this year, next year, maybe even the year out if you're a long-term investor. And yet the entire value of this is going to be based on what our belief system is about years 5 through and beyond. Nobody knows what's going to happen years and beyond. I was thinking back to this, like when the cell phone, the smartphone was introduced in, I think it was 2007. Uber was an app that was dropped 2009, 2010. It quickly changed. No one was going to think, if you were investing in a taxi cab business and looking at the cash on cash returns in the business in 2006, how could you have said by 2016, these are going to be worthless or close to it, right? It'd be very hard to even know what kind of things are going to happen. So it's always helpful to me to keep back that your intrinsic value calc is great, but it needs to be fluid, right? It has to be almost like a Socratic thing of you're asking it questions, not coming to a determined answer, because you always are just wed to your beliefs about what you put into it. Similarly, the market's changing, market prices change. Value may be what you get, price is what you pay, right? So those are always changing, and that's everyone else's narratives and coalescing around this. So I find they're complementary to each other because there can be a big gap between the two. Case study is GameStop. Now, I'm probably punching down, and this is really cheap to use this one, but this was a very crowded short with a very low enterprise value because the narrative was that there is no value in this franchise, and there probably isn't. Ultimately, it's going to be very hard to really figure out if there is. They don't own anything, really. They lease stores. It's a secondhand model. For the most part, all of their profits were coming from secondhand used games, which are moving to digital. So you could find all the structural reasons why Uber is there and the taxi cab should be worthless, or we already know this. And yet the sentiment crowding around the short interest in it, the actors who were holding those beliefs and the size of those relative to the mob that then ultimately, as everyone's seen the movie, has allowed this to squeeze almost. But I actually years ago worked with a guy, Gabe Plotkin, who ran Melvin Capital. Put Melvin Capital out of business. I mean, he basically had to shut down the fund because they lost so much money in GameStop. And even today, you could say that was a flare and it's gone, but here we are in 2025. This was 5 years ago, right? GameStop now has an enterprise value of 12 billion. I don't know why. I mean, it's probably a short again, but I guess to borrow from the John Maynard Keynes kind of idea of market can stay irrational longer than you can stay solvent. Maybe the update would be to kind of fit with Dave's presentation. narratives can persist longer than you can stay solvent. It's very hard to, like, if people have a collective belief, like you mentioned it earlier, like, you could say, like, this is paper, this money's worthless, why do you all believe this? I'm like, yeah, but the idea of that's going to change, like, what's going to cause it to change? If you can identify that, that's great. Yeah, I'll keep moving. So I look at components of fundamental analysis. It's what you know, what you don't know, what you don't know, and then to paraphrase Mark Twain, what you know for certain that just isn't so, right? And I think that you get the reflection back by looking at technicals on some of this. Like, so I can study Apple, and I can look at price to book, I can look at the multiples. That's kind of the cards on the table. Everybody sees them, everybody knows what they are, right? Management balance sheet. Yeah, I build models, I meet with management. Oh, really? Nobody else does that. ROE, margin expansion. Yeah, we can all see it, right? It's all, so what information do you have? All right, we bought the phone, we broke it down, we know the suppliers, we know some things about it. Okay, your cards are pretty good in your pocket. Like, we did some competitive analysis. All right, maybe other people didn't. You know some more about it. That's great. But you're playing against players who all have some set of this information as well. So to complete the picture, right, you want to see the price, you want to see the volume, open interest, short interest. These are just completing the supply and demand for the stock at which prices. It helps you determine what people believe at different prices about this, which might help you reconsider how you think about it. Just the general concept of psychology and narratives in the marketplace. I mean, Apple, get to kind of wrap this up with some things people could take away quickly before I'll get to some Q&A. I mean, that's been a strong trend. That's 10 years. I tend to like, when I'm looking at evaluating companies, I really want to hear a story. Oh, this is a great company. And first thing I want to look at is like a monthly logarithmic chart. Just be like, I don't know, has it been a great company? Because if it's doing this, they've been doing something right. Like, it's compounded some value over time. Now, we could say, like, maybe the narrative shifted even too bullishly in 2021. You can see it kind of stepped up to a new or higher level. Like, sure. But overall, this has been, now if someone said, this is a great company, you should buy it, and things down and to the right, and you're like, okay, define great. This has clearly been destroying value for people for a while. I won't belabor some of this stuff, but when you're just looking at like trend lines, you just want to see higher highs, higher lows. Like, this is that's a positive trend. Falling trend line, the opposite, right? Lower lows. Like, these are things that you can just sort of keep. That's fine. Doesn't mean you shouldn't buy it, but you might want to wait for an opportunity for it to be more of in transition, right? Do we see the trend line break to the upside or the downside? Is the moving average starting to moving up? Now, moving averages, there's no mystery to them. It's just 200 days moving average is just, if it's above it, everybody traded the stock in 200 days is making money. If it's below it, the opposite's true, right? So it's going to change the psychology around it. Do you have losses? Are you in losses, or is everyone in profit position on this? And that can be computer or a human, right? They're going to think somewhat differently about it, whether it's now in profit position or a loss position. Transitions, I just kind of figured tops and bottoms are processes, not points. So when people say like, oh, I think this thing is a short. I mean, I almost got killed in a short that ultimately, like, the CFO was like arrested. All that went disastrously. I had to ride out like several months where this thing was squeezing my book, like absolutely killing me. Similar to kind of the GameStop story. It was one of my first lessons in not to go like, big elephant hunting in shorts, because these narratives can persist for so long, and then by the time I had like risk had pulled me out of the position, then it collapsed. And by that point, I was like, oh, now I have this time. Like, that could have been a big win, but instead I was like, I lost so much of it going in. I had to keep the position size really small. So I would say, like, what I learned is that don't look for points. Like, things aren't going to arc up and crash. Look for processes. Structure, support and resistance. Where do people seem to come in to sell it? Where do they come in to buy it? Right? These are just like, it's big. These are things that you don't need to be a trained technician to just observe a chart and sort of get an idea of this, and it'll help inform how you think about it. I'll skip some of the relative strength. The only thing I was going to mention is I used to work with a guy at Wellington named Frank Stectira, who made the most pithy quote of probably looking at relative strength. Just that if you want to find stocks that will outperform, why don't you start by looking at stocks that are outperforming? And that's sort of his idea, was always just like, you're spending a lot of time trying to find these things that are going to turn around. Why don't you just look for the things that might persist? I found a couple of grab bag of charts I just threw together here. Local company, so I thought it'd be fun on HubSpot. I mean, you can see this is over, it's a monthly chart going back, better part of a decade. This is a strong uptrend. Like, this is a good company. I don't know, like, Now, you maybe argue it's overvalued, it's undervalued. I don't honestly know. I have a friend who works there, but other than that, like but this is a great company. That's an uptrend. That's going to, all things being equal, I would assume that will continue unless there's something dramatically changes. If there's to break that trend, and I'll give you maybe NVIDIA because this has been a very positive one. I actually was talking to Dave about this a bit. I think NVIDIA gave you signs that this was in trouble back actually a while ago. So as much as the narrative was very, very bullish, and you can see the strong trend that was in place for very long, and volume was confirming the trend, that volume started to fade on that last leg up. And actually, if you look at that, the June, July of 24, we have not surpassed that yet. So now, am I saying NVIDIA is a bad stock? I have no idea. Like, I really don't know. But this is in transition. Like, it could reassert its trend and go higher. It certainly could. But this is that could be forming a top. I have no idea. There's nothing here that makes me bullish on it, and there's nothing here that would make me outright bearish. But I certainly would choose to not play. Like, for me, it's not advice to anybody else, but there's just nothing here to tell me anything versus where it was back maybe over the last year. Nike, I thought this was an interesting one. I actually drew the trend line incorrectly. I should have slid it up a little bit. It should have actually broken back in sort of 22. That was a huge trend break from a long time coming. That's structurally really problematic for this company. So there's like, if you've got a bearish thesis on it, the chart's confirming it. I just found this one because I thought it was a good support, resistance, and a breakout. And my daughter plays Roblox sometimes, so I'm familiar with the company. But you can see this was kind of, I don't know what the narrative was, but this was bouncing back and forth between sort of where buyers stepped in and where sellers, and something changed because now that kind of broke out through that, and now we're moving higher. I'll end with the last one, which is the 10-year Treasury rate. The only reason I threw it in because I thought it would be fun to point out that when the longer trend lines are in place, the more important it is to notice when it breaks. And the longest one that I could find that's broken pretty dramatically is the 10-year Treasury. And so most of us in our investing careers, I don't think there's anybody in this room that was investing actively in the 1970s. I don't know, maybe, we'll see. But this has basically been a down to the right interest rate trend for the better part of 5 decades that broke. That doesn't mean it's going higher. It doesn't mean it's like, I have no idea. I do know that that trend is now broken, and that given how strong that trend was, is very important. So I think that's it. I will stop there and take maybe quick questions, and then if anybody has any. There, go ahead.
So a lot of those were sort of technical analysis of the charts. How much does sentiment and sentiment surveys and stuff like that come into your
coming back to my initial point about like I was going to write you a short letter, but I didn't have the time, so I wrote you a long one instead. I started to think about doing a whole section on sentiment because it is kind of crucial, right? Because that's where I think there's sort of two sides of sentiment. There's like what people say they're doing, and then what they are actually doing, right? And sort of times we look at surveys, and you get like, bull bear sentiment. I think those things are useful. They're certainly useful at extremes, right? They're less useful sort of when they're slogging around the middle. And then there's more indications of like what people actually are doing, not what they're saying they're doing. And that's like put-call ratios, that type of things. I think those are useful. They're good indicators of or we used to use sell-side sentiment on stocks. I think it's sort of irrelevant now. The one I'd actually like to do more work on is like sentiment on social media, like trending, like how things are, like what does that tell you about timing?
With the explosion of one-day options, has technical analysis changed at all in the options market, or has it influenced your stock analysis a lot?
Oh, that's a good question. I think it has, without having sort of looked at this, without like any data to support it, but just observationally, I think it's created more single stock volatility, even at the same time that we've suppressed sort of market level volatility. And so I think it's easy to, when I look at technicals, I try not to get too stuck on, it ticked below the 200. Like these are arbitrary things. Like be careful, like trying to parse it too finely, right? You want to look for confirmed breaks, volume breaks. Like you want to look at big things, not really small, tiny things. I think it can cause a lot of volatility at the stock level that could perhaps fool you one way or the other if you're not watching it carefully.
How does volatility play a role in your analysis? analysis do you think of high vol fully stocks or low vol fully
Yeah, it's not a realm that's like generally in the 101 of technical analysis. They don't often talk about it, but it's crucially important because I actually think changing vol, like vol is not stable, right? So as vol is changing, that's actually telling you something about stock. Because I would almost look like, we used to look at, I know the quant team at Wellington used to talk about this a lot, like they had like some controversy metrics. One of them was just like turnover, like how quickly are we turning over the stock? Like, right, it's like, so the people who own it today, are they the same as last week? Versus like stocks where you'd be like, the same people have owned the stock for like a half a year, right? Like there's a very different mentality about like that. And volatility is a little akin to that. Like when volatility is rising, there's a lot of disagreement. There's like more disagreement about what the underlying story is. And so I think that's it's something to take note of. And versus like strong uptrending and sometimes strong downtrending things their vol tends to minimize, right? It tends to come down because the trend is in place. When the trend breaks, the vol has a tendency to tell you a little bit about that. Any last questions, quick? Okay. All right. Thank you.